Hello everyone, welcome to Just Invest Today. And today we have a good video for you guys. Today we're going to be talking about Warren Buffett's investment strategies for beginners. Warren Buffett is one of the best investors worldwide in the globe, and we need to follow his strategies in order to invest like him because he laid out the blueprint for us. So follow these strategies in this video and you will become successful. You will generate the returns that you want. Before we get into this video, I already have a Warren Buffett video on this topic, so go look into my channel and find this video. It's the part 1 version with 7 strategies, and this is part 2 of it. So guys, if you like this video, can you please like it and then subscribe to my channel? Let's go. We're gonna get into this video right now. So number 1, the business has to be conservative with its finances. So what does this mean? When you're looking at businesses, when you're looking at different sectors, one of the things that you always want to look for on a business when you're looking at the business is you go to their balance sheet and you look for their long-term debt. We're making sure that these companies that we own don't have a lot of long-term debt. They're not heavily financed like that. Because remember, we're trying to look for companies that are very durable and have competitive advantages. And usually businesses with competitive advantages, they generate so much cash. They generate a lot of cash and a lot of extra cash, and they need stuff to do with it. So when we're looking at these businesses, we're not going to be looking at the debt to equity ratio because companies usually don't pay with their equity. We want to see the net income that the business generates. That's what it's going to be paying for the debt with. What the businesses earns, the extra that it earns on its capital. So that's what we're going to look for. So look how much the business is earning in net income and how long will it take to pay off that debt. We want 3 years or less. So if the business has 3 years of earnings and it can pay it off the long-term debt of the business in 3 years, then that's a solid business and that's what we're looking for. Because remember guys, when we're looking for these businesses, when we buy these businesses, there's usually something happening with it because we want these businesses at a cheap price. So something's probably went wrong with the company. Maybe it has a short-term problem. Maybe the cost structure went up. Something bad happened with a product development. Something caused an issue into the company. And we're looking at these short-term problems as investment opportunities. So when we're looking at that as an investment opportunity, you got to make sure that business has cash so it can deal with that problem over the long term. Because when it has a lot of cash, it's going to fix that problem if it's a fixable problem, and that business is going to be better for it for 1 year to 2 years to 3 years out. But it needs that available money, and we don't want a business with a lot of debt that's going to affect that process of being able to fix that short-term problem. So that's what we're looking for. So the second strategy Warren Buffett uses, he makes sure these companies are buying back shares. Warren Buffett loves companies that buy back their shares because that means it's generating extra cash. It's a very durable competitive advantage business. It's providing a lot of cash, a lot of cash, a lot of extra cash. And that's what he likes to see with his businesses. So we got to look for businesses that are buying back shares, but even though this is not a requirement because there's a lot of small businesses that are growing rapidly and they can't buy back their shares yet because they're still expanding. But companies that are buying back their shares a lot can be ways to look for businesses with a durable competitive advantage. Warren likes to see buybacks because it actually increases the shareholders' value, our money. So basically we have a bigger portion of the pie. Our portion of the pie expands and this can increase the earnings per share of the company. So this is what Warren Buffett's looking for, and this is what he's looking at. So when companies are buying back shares, we want these companies to do it in good faith. And this is why we want to understand these companies. We want to actually look into the business, read the 10K, read what the management is saying about his buybacks. Because stocks and companies, they can do this in bad faith. They can just be buying back their shares because their stock price just took a huge hit and they actually don't really care. They're just buying it back because they just want to prop the stock price up. That could be a reason. Or they're just doing it because they want to improve the ratios of return on equity or return on assets. They're just doing it just to prop up the stock. So we really got to understand the company, why management is doing this, and if as shareholders, we're actually benefiting from these buybacks. So Focus on the company, focus on what you know, and understand the company. Third thing, is the company free to raise prices with inflation? And this is a very key thing. You know, inflation is like 4% a year, like in the last 20 years. So we want products to actually be able to at least go with inflation or above inflation. We want to be able to actually earn more than inflation, because then if it doesn't, then we're just investing in a commodity like product. And that's not what we want in these businesses. We want to be earning a lot of money. So if we're just investing in businesses that can't go with inflation and we're just losing that value of our money over time, that business is going to get killed. So make sure we're investing in businesses that can actually price their product higher with inflation or above inflation. And again, we're gonna have to do some investigation on this. You gotta look into the product, you gotta look into the company, see how it has been developing over time. Was it be able to raise its prices with inflation or above inflation? So look at that type of stuff. And when you find that it can, then we can actually keep investigating this company. If that business can't, it's gonna act like a commodity type business, has no pricing power. The price of the products will be all over the place, and you don't want a company like that. You want a company that's more dominant. So check for that, and if you find it, keep going in your investigation of the company. And the last Warren Buffett investment strategy: are large capital expenditures required to update the plant and equipment? And this is the question that you have to ask yourself. And again, you gotta use research and you gotta read the 10 case to find this out, because Warren Buffett's strategy, he likes the companies that are very secure. He doesn't want companies that you have to keep updating and keep spending a lot of money, because spending hurts the gross profit of the company. So imagine you have to keep updating your plant and equipment year after year after year to keep up with the competition. He doesn't like that. Like a car manufacturer, like you got to keep building stuff, you got to keep inventing new stuff, or like a programming, you got to keep making new software or something like that. He doesn't like companies like that. He likes companies where you can just invest one time and the capital expenditure or the plant and equipment will last 20 years and you don't have to keep investing back into it, because he knows that product is just going to keep building and building and keep generating gross profit without spending. Because remember, spending hurts our profit, the money that we make on the company. So he likes companies that where you can just have the plant and equipment, purchase it one time, and you can hold the same equipment for 20 years and it won't become obsolete. And that's what the companies he loves, like Coca-Cola, like a gum factory, like insurance. Like you don't have to spend a lot. You just have to just like keep seeing the profit come in without spending a whole lot of money. And those are the companies he likes, because he can see the future of that company. He knows that the company, the product won't be obsolete in 20 years. And that's all Warren Buffett cares about. He just cares about if he can put his money in here and just not touch it, not take it out for 5 to 10 years. And those are the companies that he loves. So guys, that's the end of this video. If you liked it, can you please like this video, subscribe to my channel, and I'll get back to you in the next video. Peace.